everyone, again. This is Gilbert Jalad. I'm talking to you here from CPLS headquarters downtown. This is Tufts On Tax, where all your tax law questions are answered here. Any trouble you are having with taxes regarding lawsuits, trouble with employers, businesses, friends, family, even with the IRS, your peace of mind is right here with Mr. T. Scott Tufts. He is the expert and the master when it comes to taxes and tax laws, so you definitely need his expertise. You can call him at any time here at CPLS at 877-647-7887, or you can go to cplspa.com or simply email him at stufts@cplspa.com. That's stufts@cplspa.com. Now, Mr. Tufts, I'm going to give you a little brief to remind you. He focuses on how tax forms and other issues impact people's daily lives in ways that are often overlooked or unknown. Certain tax forms like the Form 1099 NEC or 1099 miscellaneous or Schedule K or Form 8082 when filed can lead to litigation. So he can help in that, definitely. You can call him again and you can email him. How are you, Tufts? Welcome back.
Good to be with you.
Good to be with you too, as always. And now we have a bunch of topics we're going to mention today, but we're going to focus on something I have in mind here from this list.
Yeah, and you know, Gilbert, one of the things as we roll into 2021 that we're trying to do here is the forms that folks worry about when they're doing their taxes. There are many different types of taxes. There's many different situations. And we're getting the word out that, you know, there are a lot of questions, let's say, that are on someone's taxes, not just numbers, not just dollar amounts. And I think that's often overlooked. And yeah, you may have some software that helps you prepare a return, or you might have an accountant or someone working with you, but there are little tricky questions in there, and they have to be answered accurately. And so you've got to know about that. And we're seeing that cryptocurrency and virtual currency situations are coming up more and more. Expect the IRS to look at those closely. There's a yes/no box that says, are you engaged in cryptocurrency? Again, these are the things that are coming out now with the way taxes are done. And because it's done electronically, Gilbert, you may not even think, it might seem like a push of the button to get your taxes done. Mm-hmm. And yet, therein lies the dilemma. If there's 20 questions that you've answered that are very important and you really haven't spent the time on them or even had any input on them, and some of those questions are very important to the government as they gather data, then you've got to have your guard up. And so we're going to get the word out, and that's kind of the process. And so what I wanted to do today is get our listeners to understand our kind of menu items of all these forms that kind of get folks in trouble or create some situations where litigation can arise. If we can get the folks aware of that type of form that creates these problems, then they can get the advice up front before it's too late. And then the other part of this is we'll talk about a particular thing that's developing for our folks who are Schedule C familiar, and those are the ones who are the sole proprietors or people that wholly own an LLC, and we'll talk about that today.
And we have a form here, a sample form of the Schedule C we're looking at. Of course, and like you said, this is creating tax troubles. Right? And there are, I have 10 on my list here, and we can go and talk a little briefly about each one, but we want to focus really on one today. Now, the first one on my list is Partnerships, LLC, S Corps, Trusts, Form 1065, 1120S, and 1041 and K1.
Right. So on this one, Gilbert, this is going to help us think about people that are in partnerships or complex arrangements, right? So let's say they have LLCs or S Corps or trusts where there's a connection needed between an entity or something that is gathering in the income and expenses, and then they pass that through or pass that out to you in the form of a K1 that then goes on your tax form. So the bottom line is you're handed a K1 because you're in a trust, or you're handed a K1 because you're in an estate, or you're in a K1 because you're in an S Corp, or you're handed a K1 because you're in a partnership or LLC. that means you have partners, then that K1 is heading towards, you're handed it and then you hand it to your accountant. But how do you know what's right on that K1, or if it is right? And if it's not right, do you know what to do?
Good question. And of course, you're the expert.
And we can help with that, because at the end of the day, Gilbert, if that K1's wrong, they got to file the 8082. And there are a lot of situations where folks are not ready to do that, and that can be a problem.
Absolutely. And number 2 here on our list is special foreign operations and the new K2 and K3.
Right. So this is taking the partnership concept and saying what happens when they operate overseas with an international involvement. We know from the new K2 and K3 forms that are coming that there's going to be a lot more information that they want to gather on your international operations. So folks are not, we want them to be aware that if they have any kind of overseas operations and they're in a partnership, that the K2 and K3 are going to be very important to fill in properly.
All right. And number 3 is estates and K1s forms 1041.
So that one, again, we have a lot of folks who unfortunately go through death in a family member. They then find themselves in an estate where there's probate. And then the question is, what do they receive as beneficiaries from the consequences of the estate? And we expect large estates to then have to file a tax form. That's a 1041. And then, of course, it kicks out a K1 to you. Again, same situation like the partnerships. Are you aware of that K1? Does it accurately report what it should? And do you even know what to do with it?
And number 4 here, we have foreign entities and trusts form 3520.
So this is another situation where if just like the foreign operations that we talked about with the K2, K3, the 3520 and the 5471 situations, basically if you have a foreign entity, meaning you have a foreign corporation or an entity formed somewhere else, and you are a U.S. citizen, you've got to be sure that you bring it back home and get it all reported properly. And there are actual forms that if you don't file the form itself that reports on this, then you will not get a statute of limitations, or you'll have a severe penalty for not filing these forms.
Oh, wow. And number 5 here is sole proprietorships and wholly owned LLCs and disregarded entities, Schedule C.
Yeah, so what's happening here is we're seeing more and more cases where folks will say, well, I'm an LLC, but because they wholly own the LLC, and let's assume they really do wholly own the LLC, then it's 100% theirs. And unless they opt to become a corporation for tax purposes, an S corp for tax purposes, or a C corp for tax purposes, that LLC will be treated as if it doesn't exist for tax purposes. And when I say for tax purposes, let's kind of focus at the IRS level, because what we're then talking about is it's really akin to a sole proprietorship, and it ends up on a Schedule C. Now, it theoretically could end up on a Schedule E if you have passive real estate, but for our purposes, it's the sole proprietors and those who wholly own an LLC who find themselves using Schedule C that we'll talk about here.
Okay. And number 6 is disgruntled workers, W-2, matching, trust fund taxes, and
the CAWR department. So what's going on here, Gilbert, is we're seeing more and more of this where there's matching, meaning that the W-2s, if they get filed and they're done properly, Social Security is involved, you want your wages properly reported. What do you do if that's all falling apart? And then, of course, you've got the trust fund responsibilities. These are the people who are involved in corporations and are trying to meet payroll. If they're signing the checks, then they could be personally liable with a tax liability if the business is not paying those payroll taxes. And then the CAWR department is something that the IRS has that is looking to make sure that everything matches up with Social Security, and they'll go back, far back in time to make sure that those W-2s and Social Security reportings are lining up so that everybody gets their proper credit for Social Security.
Number 7, Form 1099 NEC and independent contractors.
Yeah, so the IRS in the last 2 years, we're doing a lot of speaking on this. NEC stands for non-employee compensation. So this is your independent contractors out there. The 1099 NEC is a new form. It actually was around in the 80s. It's made a comeback, and the IRS wants a separate return to identify these independent contractors receiving NEC, which is non-employee compensation. There's a form dedicated for that, and it's no longer going on the 1099 miscellaneous form.
All right, and then we have number 8, which is Form 1099 miscellaneous and settlements. Is it income?
Right. So once you take off the independent contractors out of the one form, 1099 miscellaneous, and put it on a separate form, but the 1099 miscellaneous still has a whole bunch to it: rents and settlement funds and payments made in the healthcare context. There's just a lot of other features of the 1099 miscellaneous form. But the biggest one is when you have settlements and lawsuits, and you got to learn, is it taxable or not? And then we'll generate. And what happens if it's a mixture, right? People settle cases, and it might have some compensation in it. It might have some back wages or something like that. So it might be partially taxable, partially not. And they need to be aware of that when they get this 1099 miscellaneous.
And number 9 here, we have abusive tax shelters.
Too good to be true. So Gilbert, on this one, yeah. So if you find yourself in a complex deal and you're paying some good money to basically save a whole lot of taxes, and it's kind of put together almost like a product, meaning, like, let's say they sell it to you. You essentially buy tax savings. Believe it or not, that can exist. So for many of our large business owners and planners, they might get presented with a PowerPoint slideshow and some details or some kind of thing that's marked confidential, and it's like a little secret. And what it does is say, look, you're going to save a whole lot of taxes because we have found a way through the Internal Revenue Code that says this is going to be the result. And you get it and say, wow, that's awesome. I'm going to save a huge amount of taxes. But they say, don't tell anyone. And then you feel like you're like, wow, this is amazing. So it's if you find yourself talking to a friend and saying, you're not going to believe this, but I did this and they've guaranteed me it'll work, look at the fine print and make sure that it's not one of these abusive tax shelters.
Wow, good to know. And I'm sure we have to go back and talk more details about this one. Form W-9.
Yeah, so we don't want to overlook this one. This is the form that really gets the ball rolling. All of our businesses out there need to have good practices in having a W-9 in place. The W-9 essentially allows someone to certify who they are, what their identity is, and what their tax number is or Social Security number is. And if that gets mismatched, meaning let's say I'm writing down a number and I put the wrong number down, then it creates a mismatch. The IRS can then cause a backup withholding situation. So our businesses out there need to have, on top of this, before they start the vendor relationship, not at the end, and make sure they have a W-9 on file.
And I'm sure if a mistake on this happens, that's a nightmare to fix.
Yeah, right? It can create a 24% backup withholding obligation on what is otherwise a normal payment situation. So you can imagine if you get the number wrong. And then the other thing that happens, Gilbert, is people's addresses change or the name of the business changes. And let's say you think and the check gets payable to you and it's the wrong name, and then you don't think anything of it, but it's going to end up on a particular tax form in a particular slot, and that may not be the slot you wanted in.
Oh, wow. Now, we mentioned all of the 10 on the list, but let's focus here today. I think we need to focus on sole proprietorship and wholly owned. Let's talk more about that. When is it for, if you're working for yourself, when is it time to go corporate? So take a situation where you're under contract with someone, and you start to ask yourself, do I need to be incorporated because I understand it offers liability protection, let's say, meaning that you've heard from someone that says, hey, look, you really need to incorporate because that'll separate it from yourself, your personal assets, and maybe that'll protect you. But when we say incorporate, we a lot of times now the LLC is very popular, very easy to form. And somebody will say, well, just set up your own LLC. And they'll file the paperwork with the state and become an LLC. But if they don't have an internal operating agreement, a written operating agreement,
they're in trouble. And you say, well, why would they be in trouble? And it's because if you don't have a writing describing how that LLC business is to operate in the event of, let's say, disability or death, then what happens to your business? Correct. So for our workers out there who find themselves wanting to be a business, then if they incorporate, meaning let's say they start an LLC, where is their, how is that all going to play out? And then tax-wise, it gets even more interesting or more confusing. And what happens, Gilbert, is that if you set up an LLC and you do not elect to be a corporation, an S Corp or a C Corp, and you are the 100% owner of that business that you just set up. And notice I said if, but let's assume you own 100%, nobody else. You don't have a partner, you don't have anyone else with an interest. Then that is going to come back to as a trade or business on your Schedule C of your Form 1040. Now, why do I mention that? I mention that because what happens if it's getting a little murky? Like, let's say, Gilbert, I own a business, but you think you own a piece of it. And I tell my accountant I own 100%. And I don't tell them that you exist. But between you and me, we're splitting profits, splitting the money. Then now we're really partners. But I'm the only one with the tax form and the only one that it's getting reported that way. If we go to court, right, and the court says, and we're in discovery, and you say, well, I want to see your tax, I want to see the tax returns for the business. Now you're going to get into it because now guess what? You're going to get my personal tax return because inside my personal tax return is a business tax return. What's the business tax return? The Schedule C. What's the Schedule C and why is it a problem? Because it's saying we're not partners. And you then get to say, well, show me how much you made. Because it's really not how much you made, it's how much we made.
Correct.
See that? So when things go from you to we, or me to you, or us, then all of this gets all flushed out. So when we look at the Schedule C, we need to ask ourselves, is it really all on one, right? And spouses have this problem, partners have this problem, on and on. So and then what the IRS does is there's a lot of line items on the Schedule C. So there's some of them that require the substantiation, meaning your written support. And then something that folks don't know, some of them, if records have been lost, we can help them use what we call the Cohen rule. And the Cohen rule allows within certain limitations the estimate, meaning that if everyone knows that this business needs electricity to operate, and you can't pull together your utility records, you still should be allowed an estimate of what those would be based on whatever information you have. Now, of course, you can go to the utility company and get it, so that's not as great an example. But I use that as the idea that folks need to understand that there's a Cohen rule out there, and there's other things about the Schedule C that we can talk about. But for now, the main thing that we want to get the word out on is that if you have a Schedule C or a wholly owned LLC and it's ending up and being reported on the Schedule C, but you have partners or you're talking to someone that might be a partner, you've got to be really careful. And then the last thing I'll say, Gilbert, on this, and again, we can't cover it all in one shot here, but but an operating agreement, Florida law, and there's other states that do this too. What happens when you don't get around to doing that operating agreement that describes how you're going to run the show? If the state allows an oral operating agreement, which Florida does, for example, and you then are using your oral understandings, then it's going to be my word against yours, won't it? If we're right, if you say we're in business together, and I say no, we're not, and I say prove it, and you go, you prove we're not, and then and we look at the money's being split 50-50, right? But I have the articles of organization with the state that say we're that I formed it. But I don't have an operating agreement. What I'm trying to get the word out on is that will go into the courts as a he said, she said, or in our case, he said, fight over what our understandings were. They'll pull all the emails. We'll look at all our course of dealings and decide, well, what were you? Were you 50-50, 75-25, 100-0?
So the results on this would depend on
So the
what they
Schedule
find
C,
out?
so one of the pieces of evidence that would be maybe the tiebreaker, may be important to look at. And this is where, because the general rule is your taxes usually don't make the way in the courtroom. Judges like you, Gilbert, will put their hands over their eyes and go, oh gosh, let's not talk taxes, because they're private. And the courts will try and get to evidence that's not taxes. But in this example where the business return is going to make the difference between maybe our understandings and provide something that's got a authenticity to it, or at least pinning down someone under penalties of perjury what their understanding of the relationship is, then it's going to be a piece of evidence that's going to come out. And sure enough, that's what happened in a Delaware case in the last 2 months. Wow. And it's really fascinating because the courts got into the Schedule C, and that amazes people because they say, wait a minute, you mean to tell me they in a courtroom deciding a dispute between two people, they're looking at a Schedule C in the courtroom in Delaware, in the Chancery Court in Delaware, because what it was to show that one person took the position that they had 100% ownership, right?
So they did exactly what...
Yeah, so they did it right.
Oh,
so
wow.
they said, I'm the 100% owner.
Okay.
I own it, you don't, and I have a Schedule C. So what they do in that situation, Gilbert, is they'll say, well, let's talk to the accountant. They go, so you go to the accountant, Mr. Accountant or Mrs. Accountant. Did you know anything about another partner? No. So I never told you about another partner. No. Right?
That changes things.
Right. Well, where did that $50,000 come from? Oh, that was a loan. From who? My partner. Oh.
Okay, so that leads to...
Right? See what I'm saying? Okay. So you said, well, I didn't mean to say partner. I meant my lender. See how we're going down that road a little bit?
Or loan me the money.
Exactly. Right. But then I go to you and say, are you a partner? Oh, yeah, I own a business. Well, what paperwork you have? It's all handshake and a good deal. You go, do you file tax on it? Well, I trust Scott with that. He's taking care of all that. So you see the deal? So, we're kind of having a little fun with that, but the idea, though, is you'd be shocked at how often folks kind of get started with a business. They get the articles formed, and they're going to get around to that operating agreement, but they never do.
They never do, yeah.
All right?
I can't believe in 2021 they don't do that and do it.
Well, we see it, Gilbert, and it's in all kinds of situations where you would normally think it wouldn't. And again, 50-50 is a tough thing, right? Because it's a great thing when you have a trusted business partner, let's say, and you're 50-50. But what does 50-50 mean? You have to both agree.
True.
And how often do we disagree? We never disagree, you and me. But I mean, obviously, if we're 50-50, and how are we going to break that tie?
Yeah, that's right.
Right.
Well, you heard it, folks. Be careful and have everything in writing to avoid any trouble, especially with taxes and the IRS. Well, I guess that brings us to the end of this episode. We're going to continue talking about this and all of these forms and troubles on the menu, like we mentioned today, one by one, and explain more in detail.
Yeah, so what we'll do with that, Gilbert, is as we hit some of these topics that we were mentioning, what we're trying to get the word out is real life cases, real life situations that discuss that. And then the other thing we're going to do in our season here is upcoming is we're going to bring other people who from outside the tax world who are in law and in different areas, and then we will work with them to see, well, do these taxes really affect them in their practice? Correct. And the reality is it does, because taxes touch almost everything.
Absolutely.
Unfortunately. And so for us, if I can then help them out or help their clients out, then that's a good thing. And because I think you break barriers down. If I say tax and you go to sleep on me, or you go blank, that's not a good thing. So we'll see if we can break it down and help folks see what the warning areas are and get to somebody like me.
I hope so that we can clarify that to them more than me, because I do get go blank. You say taxes and everything gets complicated. Anyway, that brings us to the end of our episode today. Thank you everyone for listening and watching. You can call Mr. Tufts at 877-647-7887, or you can visit our website. It's going to be be on the screen in the bottom. You can subscribe to the YouTube channel as well. It's cplspa.com, or you can email him directly at stufts@cplspa.com. That's stufts@cplspa.com. Thank you and have a wonderful day.